Okay, now we're going to get into just a fairly short lecture on forecasting financial requirements. Students always ask me when they're doing their business plans, how do I forecast this? How do I forecast that? What's the relationship between this and that? So we're going to look into that a little bit right now with this little forecasting chapter. So let's look at what we might be able to, if I can get that chart to flip. It's not flipping for me. There we are. Got it going. So bear with me just for a little bit. So here is the term that I want you to get a little bit familiar with. Pro forma financial statements simply means this is the projected financial statements for a company. And oftentimes, if you're looking at, say, Wall Street Journal or Barron's financial analyses, they'll talk about pro forma. What that means is that the analyst is simply projecting what might be happening with a company, either in sales or in their income or in their balance sheet or in their cash flows. Any of those things can become pro formas, and we're going to talk about that a little bit, because in your business plans that you're developing, I want you to include a 3-year pro forma financial statements. Now remember from Chapter 10, the financial statements for a company are what? The income statement, the balance sheet, and the cash flow statement. So remember those three. So in your business plans, you need to have 3-year pro formas of your financials. Now there's one additional pro forma that you're going to need. We'll talk about it later in this lecture, but that's a cash budget. And I want you to have at least 1-year cash budget pro forma in your business plan. So you're writing a business plan about your company, you're putting in your pro forma financials. I want you to have at least a 1-year cash budget set aside. Why do I want you to do that? Because if you ever operate a small firm, you need to have a cash budget set up. And typically, a small company will do this every year, a cash budget by month, so that you can forecast what your cash needs are going to be. Now, why is that important? Because a time will come when you will need to go to your banker and set up a short-term line of credit where you can put in a short-term cash into your company to cover cash shortfalls that you have and allow you to pay your bills. It's a standard operating procedure. It's a short-term debt. You pay that debt back in a month or 45 days, and then when you need it again, the banker will have it there for you. In fact, I recommend that if you've got the credit rating that you need and you can do it, you have the relationship with a small bank or a local bank, go to your banker when you're setting up your company and say, hey, the time will come when I'm going to need a short-term line of credit. I would like to go ahead and get my company started, but after we get it up and going, I want to come back to you and work out an agreement and sign an agreement so that I'll have some protection when I run short of cash with my company. Now, let's go to the next chart. Let me make sure I have the right one. Yeah. So here's the other thing I want to point out on this chart right here. You're really addressing these questions. How profitable can the firm be? How much and what type of financing am I going to need, and will it be debt or equity? And will the firm have adequate cash flows? Now, when I say debt or equity, I hope you understand what I mean by that. One good way of thinking about this, these are loans, this is stock or investor checks that come in. Okay, now let's look at profitability. Net incomes depends upon sales, cost of goods sold, operating expenses, interest expense, and taxes. Where have you seen that before? That's in your income statement, right? So you see those things in your income statement. Now, so in your pro forma income statement then is going to tell you what your income profile is going to look like going forward. Now here's a good little question down here in the green box. If we're doing so well, then why am I always so broke? I'm going to answer that question in a little bit more detail later, but this is what I call the growth trap. Just remember that, the growth trap. When I'm growing the fastest, it's when I need the most cash, and most of the time that's when I don't have that cash. And I have seen more than one small company go bankrupt in the midst of a rapid growth cycle in the company. So let's be aware of that. We'll talk about it some more a little bit later in the lecture. Now, as you do your pro forma statements, both income, balance sheet, and cash flow, set up spreadsheets so that you can do some variability analyses. And this little spreadsheet right here is one that works for a pro forma income statement. You can see that they've set up a kind of a definition area up here of different terms and values they're going to use. And then they have all of the elements of the income statement here. So now they can go through and by varying sales or varying one of these assumptions up here, they can see what happens to the bottom line down here on the pro formas. So in year one, they're forecasting this. In year two, they're forecasting this. They might want to do some what-ifs. They might want to do some changes around to see what could they do to improve their situation. Now, let's talk about working capital, net working capital, bootstrapping. These are terms that we've talked about repeatedly. By now, you know what working capital is. By now, you know what net working capital is. Let's look at bootstrapping. Bootstrapping is basically a philosophy that says, I'm going to minimize how much money I spend. I'm going to get my company started by minimizing our costs. Now, you can't say, hey, I'm just not going to have any costs. You will have costs. But oftentimes you can scramble and you can come up with ways of handling those costs that does not involve incurring debt. So that's primarily what we're talking about. We're talking about avoiding incurring debt so I can grow my company, increase the value of my company so that investments later on will be more attractive for my company. So bootstrapping is a philosophy that I really endorse, that I really encourage for small companies. It's one you would be wise to think about yourself if you're going to start a small company. Now let's look at this this relationship right here. Assets to sales financing relationships. Remember the growth trap I was talking about a moment ago? This kind of gives you an idea of why you have growth traps sometimes. An increase in sales results in an increase in asset requirements, most often cash, results in an increase in financing requirements. That's what causes the growth trap. So my sales are increasing rapidly. I've got to have some way of financing that increase in sales. That's the asset requirements. And all of a sudden, I've got an increase in requirements for cash, something I've got to have in order to finance my sales, and I don't have it, and that's when I declare bankruptcy. So we're going to spend some time now talking about how we determine our asset requirements. And I really want to say, be careful about using that term requirements there. Let's say it another way. We're going to determine how many assets we can afford. That's another way of looking at it. So one way you want to do that is you want to have a good understanding of the industry that you're working in and what the typical ratios are of assets to sales and percentages of sales for companies like yours in that industry. So you want to have that information. It can be found. I mean, you define what kind of industry you want, and there's sources that will tell you, well, these are kind of the typicals for that industry. Most often it'll be the industry trade associations will have that. So you want to look at, make sure you understand the ratios like assets to sales, and make sure you understand what the percentage of sales techniques is. Percentage of sales technique is a way I have of estimating assets based upon my sales. And we'll show you an example of that here in just a second. All right, let's look at percentage of sales just for a little bit. This is typical, and I don't know what industry we're talking about here, but apparently in this industry, cash requirements normally are about 4% of sales. Accounts receivable typically run about 10% of sales. Inventory typically runs about 25% of sales. And so now I can go through and I can figure out or make a rough estimate of what my working capital requirements are going to be for this company in year one and year two, and I base that upon what? Sales. So I forecast my sales. Now let's stop right there. I want to make a really important point. You cannot forecast sales unless you know what your market is and you can quantify your market. So you'll hear me use this term a lot, particularly on the grading notes that you'll be reading. You'll hear me say you've got to quantify the market. And some of you heard that on the responses to your rough draft A's. You've got to quantify the market. So understanding the market means that I can quantify it. I can put a dollar value to that market, and more importantly, I can put a dollar value to how much of that market I can actually capture. So that's really important. I can't do sales until I know those numbers. So the basic principles for financing firms. Let's look at this now. The more assets a firm needs, the greater financial requirements are going to be always true. If you're in an industry that's heavy on assets, you're going to have big financing requirements. A good example of this would be trying to break into the airline business, hauling passengers around. Tremendous investments in assets for airline companies, and so they have big financial needs. They have big debt relationships they're constantly working on with the financing houses. You need to finance your growth. The company needs to finance its growth in such a way as to maintain proper liquidity. Well, we measure liquidity by what? Our current ratios and our asset test ratios. That gives us a measure of our liquidity. So that tells us what kind of liquidity we have when we set up our pro formas. The amount of total debt used in financing a business is limited by the funds provided by the owners. What is that? That's equity, right? The funds provided by the owners is the equity that's been put into the company. The amount of total debt to be used in financing will be related to that, dependent upon that. Now, let me qualify that just a little bit. Sometimes if you're financing fixed assets, hard assets, you'll use those assets as collateral, but you'll also need some cash to put behind it, and that'll be typically be the owner's equity. Some types of short-term debt maintain a relatively constant relationship with sales. That's true. Short-term debt, let's say it another way. Current liabilities, let's say it another way. Accounts payable and the short-term portion of long-term debt, that's all short-term debt or current liabilities. And typically that has a more or less constant relationship with sales. It'll run fairly constant. Equity ownership comes from the investments of owners and retained earnings. We'll talk about this some more here in just a little bit. In fact, we talked about that in the lecture in Chapter 10, if you recall. When we moved from the income statement to the balance sheet, we talked about retained earnings. Okay, liquidity, some definitions here. The degree to which a firm has working capital available to meet maturing debt obligations. The current ratio is the ratio of current assets to current liabilities. That's the current ratio. That tells you how much cash you have available to cover your current liabilities. Typically, you don't want that ratio to get below 1, and ideally for a current ratio, you'd like it to be 2 or above. The debt ratio is the ratio of debt divided by your total assets. So that measures how much debt you have against those assets that you're carrying on your balance sheet. Sources of equity capital. There's the external equity, that's your owner's original investment. There's profit retention, that's the retained earnings. And there's also internal equity, that's the capital from retaining profits within the firm. And that's a little bit different than the reinvestments of profits in a firm, because sometimes on internal equity, or let's say it another way, sometimes I'll take money that never goes into the equity bucket, and I'll use that money to pay for assets basically real time as I go along. So I'm just taking cash out of my cash budget to help pay for those assets. Forecasting financial requirements. Here's a good little equation to remember. Total asset requirements or total asset needs equals the total sources of financing. What that says is I cannot get more assets than I have the ability to finance, either pay for in cash or generate the cash through my operations or borrow the money. So that's equal to spontaneous financing plus profits retained within the business, that's equity, or plus external sources of financing. Okay. Let me back up. Profits retained within the business is not necessarily equity. It's not necessarily retained earnings. They could just be cash that I'm accumulating. Now, here's a pro forma balance sheet spreadsheet that you can come up with. This is a good example, too. It's very much same comments here apply that I made with the income statement. Develop a little spreadsheet, make your assumptions, and then look at your balance sheet pro formas. And that way you can do some what-ifs and kind of measure what you need to do to adjust to make that a little bit better than what you might like for it to be. You can do a similar thing with the cash flow statement. And I want you to notice here that the cash flow statement, once again, is divided up into the 3 main sections. Operating activities, investing activities, and financing activities. So those are the 3 major sections right there. And you probably need to work through this and kind of see what's happening here. Let's look at for D&R Products Incorporated. In year 1, they had a net loss of $33,000, and they had depreciation of $4,000, and they had an increase in accounts receivable, cash outflow of $25,000, and an increase in inventory, cash outflow of $62,500, increase in accounts payable. That will ultimately be a cash inflow. And so my cash payment for inventory is $42,500. And now my increase in accrued expense is $10,000. So I can see here that my cash flows from operations in year 1 is a negative $86,500. Now in my investing activities, you see that I have to pay for some assets, $50,000 invested in assets, equipment probably. And then on the financing side, I had to get some short-term debt. I had to increase my mortgage. I had to increase my stock equity, and so you see I raised quite a bit of money from equity. I issued stock, and so I had cash flows from financing of $146,500. I like to keep $10,000 in my bank account, and my beginning cash was zero, so my ending cash, as shown in the balance sheet, would be $10,000. So if you go through all that whole line right there, you'll see how I ended up with that. Now, the next year I start with $10,000. That's this number right here. It goes to right there. That's the $10,000, right? Now, I'm going to put some cash. I'm going to keep some cash aside, $5,000. So I know that going in, that's going to be kind of my cash policy. Let's go back up. In year 2 now, I have a net profit that's positive. I still have depreciation, and so I end up with an increase in accounts receivable now that's a little bit less. And I end up basically with a cash flow from operations of a positive $5,600 instead of a negative $86,500. So I don't have any investing activities behind that. I do have an increase in short-term line of credit of $2,400 basically. I'm going to pay off a little bit of my mortgage, $3,000 worth, and I get some cash flows from financing here of a net cash flows from financing of $625. And so I end up now ending cash at the end of the year. I'm going to add $5,000 in, and so now I have ending cash of $15,000. So now you see, if you build that little spreadsheet like that, you can play with that and see what's going to happen. As a matter of fact, if you spend enough time with this, you can link it to your income statement and your balance sheet. That's what these notes here are for, right on this side of the example. If you can link those cells to the balance sheet, you're a step forward. Now remember, early on I said I want you to do a cash budget. This is the way you do a cash budget. You make some assumptions. You know, I'm going to have some accounts receivables, and I'm going to have some cash payments, and I'm going to have some sales. And so let's look at how cash is going to flow. These are the assumptions I would make. I'm going to 40% of my sales will be cash sales. 60% will be credit sales, and I'll collect half of that in 1 month, half of it in 2 months. Now I can go through and say, okay, here's my monthly sales forecast. This is going to be my cash receipts going forward, and this is going to be my collection of sales from accounts receivable. And so you can see I use these assumptions now to build these numbers over here. You see that my total cash receipts in the first month will be $1,600, the second month, and so forth. Okay, so now I've got some idea of what my cash coming in is going to be. Now I can also calculate what my cash going out is going to be, and that's what all these things are right here. So once I put my expenses in here, I can now see what my cash flow from operations is going to be. It's going to be in the first year $8,950, first month, second month $9,200, third month $8,000, all negative. My personal investment is $110,000. So I have a purchase of equipment and building of $50,000. I have a mortgage from the bank of a plus $30,000. So I have at the end of the first month I have $81,050 on hand. Now I go through the same technique, and I'll use this $81,050 on hand. I can see at the end of the second month I've got $71,000. So what's happening here? My cash budget is telling me, look, I am steadily chewing up all of my cash. So something's going to have to turn here before too long, or I'm going to be out of money, and I may have to put some more money back into the operation. So that's the beauty of a cash budget. It tells you a lot of things. So here's some practical suggestions. You want to develop realistic sales projections. You want to make sure your assumptions on your projections are really clear about your marketing and pricing plans, and in your business plans, don't get too carried away with this. Be very realistic in what you're trying to do. Don't use unrealistic profit margins. To the extent that you can, try to figure out what the standards are for the type of business that you have. Don't limit your projections to an income statement. You're going to have to go further than that. Provide monthly data for the upcoming year and annual data for succeeding years. This is your cash budget primarily. Avoid providing too much financial information. In your business plan, you want to be very careful about this. Most of the time, I would not suggest putting a lot of financial detail into a business plan unless you know the person who is looking at your business plan is very serious about either buying your company or investing in your company or loaning your company some money, and then you can give them the details that they want. But just be very careful about how much data you release. Be certain that the numbers reconcile, and don't just be unrealistic about this. But as you look at your income statement, balance sheet, cash flow statement relationships, make sure they all reconcile, they all hang together. Okay, that concludes Chapter 11, a little short lecture, but there's some really good information here. I hope you'll use this as you begin to put together your financials for your business plan. Okay, that concludes our lecture for today.